So now we want to look at some of the shifting, as we talked about inflation giving way to stagflation, what are some of the movements under the CPI, PPI, and what does that mean going forward? And one of the things that we want to look at is the percent change due to delta. So just give you an idea of, we have seen some reductions. It's not really crazy. At least I can speak anecdotally. Things haven't changed much by me, but this gives you an idea of when we're comparing things to 2019, because hard to remember what 2019 looked like after 2020. So you're starting to see that you're coming back below 2019 norms, which again is just putting some of that pressure, those pressure points when we start looking at activity and what we're going to see going forward. And then there's also that slowdown to the office. So we had seen some of that acceleration. Now we're seeing companies say, look, if it was, some were already back, they were sent back home. Some were told September, now it's October. Some were told October, now it's the January of 2022. So you're starting to see some of this slide over in terms of work, which again is just going to impact some of that activity. But now when we start turning to container rates, you're getting an idea that there's another shift up when you start looking at coming from Shanghai. Everything is now almost cleanly over 13,000, and it's being driven by a lot of restrictions when we start talking about new flow, new shortages, new supply chain issues, as COVID has resulted in several shutdowns, in varying degrees within Asia and the most recently in China, which again is just going to keep prices elevated, costs going up, essentially keeping that inflationary bid. But then when we look at PPI surprise, the surprise is really, it's less of a surprise and more about, how much cost is coming into services versus goods. And that's when, as we've been talking about, as you get this pivot from goods to services, we're seeing these price increases, which is why I think there's been an underestimating view in the market on how quickly these prices are going to go up, and that has really caused some of these estimates to be so wrong in comparison to PPI, because again, these are those prices that are just shifting up and that are going to weigh on what the future cost is going to be and how that is going to be passed on to the consumer, again supporting some of that inflation. So then when you look at as the core inflation continues to ebb down, continues to give way, we're just not seeing a whole lot of the inflation go down. There's a lot of offsetting pieces to that when you start looking at rent, when you look at home prices, a lot of these things that are going to offset some of the benefits of, cheaper car prices normalizing a bit, some of that coming down, you're going to have some of that offset, which again is going to support some of that CPI. But when you look at it on an aggregate, when you look at core PPI excluding trade services, when you look at the trend, when you look at core CPI index, you can see we are now well above trend, not only just above estimates, but also above the trend that was really kind of laid out based on where people wanted us to be and where we currently are, just showing how quickly we're seeing some of this overheating and you're starting to see some of these pressure points. So then when you look at PPI, speaking to, again, where some of those expectations are, final demand for PPI was expected at 0.6, came in at 1%. Less food energy was expected at 0.5, came in at 1%. Then less food energy, trade services was expected at 0.5, came in at 0.9%. Again, you're seeing year over year, month over month, a lot of these costs that are still yet to get pushed down and will continue to push down into the consumer through the supply chain, increasing those underlying costs. But there's going to be that offset, which is why we start talking about stagflation. Are we getting to the point of stagflation where the pace of inflation is cooling off, but we're not seeing it come back down? We're just seeing it go sideways as these different pressure points, essentially exert force on these estimates and these underlying numbers. So then when we look year over year, you can see on how it's been essentially an unabated rally that has only accelerated as we got into March of 2021 when we look at the overall movements. Now, when we look at US CPI versus PPI continuing to outpace CPI, both shown year to year, by a large margin relatively to history. Spread remains negative, hovering near levels seen in the 1970s and the financial crisis. So that just means that CPI is much lower than where PPI is. So there's still more to come in terms of that movement from PPI into CPI. It's not one for one, never was, never will be, but you're getting an idea of just where some of those pressure points still remain. So then when we look at, some of the most recent Empire Manufacturing. So August Empire Manufacturing came in at 18.3 versus an estimate of 28.5. New orders fell from 33.2 to 14.8. Inventories are down from 16.2 to 6.2. And prices paid also down slightly from 76.8 to 76.1. But again, think about all the other things had these massive contractions and prices fell small. And that's what we continue to see is we're not seeing these huge contractions in prices, but you're still seeing this increase. You're still seeing this expansion in pricing just at a slightly smaller pace or slower pace, leading again back to that stagflation side of the equation with employment falling from 20.6 to 12.8. But for now, they're again still expanding, but moving in the wrong direction, which plays out in just what we're seeing. So the prices paid came down slightly, but prices received new all-time high. And look at the difference. So we're at 76.2 in prices paid, but prices received were at 48. So again, there's still more to come as it flows down. So then when you look at unfilled orders starting to go back up, delivery times starting to get worse again as we continue to see, but again, working within this sideways pattern as things are not getting better, they just maybe are just not getting much worse, which again, because they're so bad, that's still not a positive. So then when we turn to, again, the US CPI primary and owner's equivalent rent, leading by 3 months, and where the US CPI owners and rent equivalent, just how low it is and how there's going to be that catch-up trade, again, moving some of that CPI higher and offsetting some of those deflationary cycles to be replaced by that inflationary cycle. And this is just looking at the national median rent, which is now up 8.4% year over year. Again, more support for how that's going to look over time. And then rent of primary residence and owner's equivalent rent year over year are just starting to turn. So just trying to show the amount of running room these have as an offset to some of the deflationary pressures that we've talked about with, goods coming down a bit, some people balking at home prices and at vehicle prices. But then when you look at just what is happening on the housing side, housing starts missed estimates. They were supposed to be at 1.6, came in at 1.534, but building permits were expected at 1.61, came in at 1.635. So people are essentially saying, I'll get a permit, I'll sell that permit, but I'm not building the home yet. And again, that's where we're seeing some of that friction points that we've talked about in previous episodes. So then when we look at home price gains surpassed prior housing bubble peak, you're just seeing May, June, and ratio in terms of where we sit, just again showing you just where the pressure is and how there's a lot of momentum behind it. So as we go to the National Association of Home Buildings Market Index, housing sentiment continued to roll over. Seeing it here when you look at housing starts. Housing starts are starting to slow down. HMI came in at 75 versus 80 as an estimate and was 80 in the previous month, now at the lowest since July of 2020. Current sales conditions and prospective buyer traffic at lowest levels since July 2020 as well, which is still high, just not all-time highs. We're starting to see a lot of this cool down, as we've been saying. A lot of those first buyers are gone. A lot of that great, what's the best way to put it? The 760 and above, when you look at credit scores, a lot of that is dried up. And now here we sit in terms of what is happening in the market. So then when we look at U.S. import prices continue to go up at a 119.7. So you're looking at, again, import prices. We're going to import the inflation. So we've been exporting inflation for 40 years, importing deflation, outsourcing our supply chain, importing goods. And here is what we are facing on the other side of that. And that's when you start looking at import prices. So things have slowed down a bit. But when you look at PPI abroad, and again, renewed issues on supply chain, rising prices on cargoes, containers, port issues, this is going to trend higher. So it came in below estimates. The estimates were for Import prices of 0.6 came in at 0.3. Expectations ex petroleum was supposed to be at 0.5, came in at 0.1. But year over year, again, still seeing a very steady move up, which is going to keep that pressure. But when you look at exports, we're exporting some of that inflation as well, which just means that we're giving it off and passing it off to the next person, which is putting pressure on their numbers and again, you see the cycle in which we continue to roll in. So then when we look at reliabilities in the Fed, as the RRP just printed 1.1 trillion, yes, we broke the 1.1 mark. And here we are with just, again, a lot of liabilities and capital and other things on the Fed balance sheet, just to put that into perspective. And again, the loan to deposit rate continues to come under pressure, which is why they're using the RRP more, because you're taking in deposits, but you're not issuing loans. So you have this money sitting on your balance sheet. So they're trying to get whatever they can, which just so happens to be 0.05%, I'm sorry. So then when you look at the consumer leverage, that's declined because homes have appreciated. So if you had a home that you purchased for $500,000 and you have a $350,000 mortgage, well, that home is now worth let's call it $700,000, and you still have the same mortgage. So now you can go out and you can get home equity line. You can do all these different things to essentially move this in a very specific direction, moving that consumer leverage as the home prices continue to decline, to rise, in decreasing underlying leverage ratios. But the 10-year Treasury constant maturity rate, as you can see, continues to print at levels that we saw in 75, in the 70s and 80s. And again, look at what happened coming out of that, the snapback. And that's what we continue to talk about with this snapback move that we expect to see, and I think is the most likely thing to see in the rates world. But when we look at continuing claims continue to drift lower. A lot of these programs are set to expire, the remaining of them in September. So we should start to see some of this emergency unemployment benefits fall off. But one of the things that is important to look at is the population levels. We've seen this level off. So when you start talking about competition, productivity, this is where the population issue starts to come in, because as people retire, this gets drifted lower and lower, which makes it harder and harder to find people. And companies are, again, pulling in more investments into CapEx, into tech, into things to offset that, which again is coming into this world. And this is just looking at where the regular state ending, as of July, this is delayed, going back to 2.9, the extended benefits. A lot of these things are going to start rolling off, which should bring that total further down, as you can see with those continuing claims drifting lower. So now we've kind of wrapped up the U.S. In the next segment, we're going to go deeper into what's happening in Europe, what are some of the estimates doing, and what do we expect to come over the next few weeks as some of the bigger data sets start to hit for the European continent.